students, welcome to the class. This is your commerce class and the subject is accountancy. I want to tell you what is accountancy first, then we will start study. So this is our new subject for you. So I want to tell you that what is accountancy. Let us explain it with an example. Suppose you are a businessman and you deal in buying and selling of goods and production of things. If you are a businessman and you are dealing in production of things and buying and selling of goods, so you need investment. That investment is known as capital. The owner and the businessman who is the owner of the business invest money in the business. That money is called investment and capital of the owner. So that money which he invests in the business and capital which he invests in the business, he used it as further for purchases and for purchasing assets. Purchases means that he purchased the goods which he deals in. Assets are the property of the business. Suppose he deals in production and he purchases machinery, then the machinery is assets. Now, from purchases, when he do purchases and deals in production and engage in production, different type of expenses come in the way of a businessman. The expenses may be office expenses, selling and distribution expenses, administrative and distributive expenses. So, after these all expenses, the production is then ready for the sale and the goods are ready for the sale. For these sales, from these sales, he receives income. He can have losses also. But in case of income, where he gets income from the selling of goods and things, he then use this income as the payment of the liabilities. Liabilities means, for example, if he doesn't have investment money in the starting point of business, he takes loan from outside. That means maybe from banks or maybe from financial institutions. So liabilities, then incomes are used for the payment of liabilities. And the results after all the transactions and events, these are called transactions and events. So after all the transactions, the results comes and the results may be profits or losses. So if the results are profit, these results are communicated to external users, tax authorities and internal users. What are external users? First of all, external users are those users who use this information as externally the part of the business. Those persons who are externally the part of the business means they are not directly belong to business. Creditors are the person who give us purchases, who gives us goods on credit. They are interested in our profit because now they want their money back. So after this, tax authorities means government is interested in profits of the business because he wants to know what are the profits and what will be the tax from that businessman which is receivable. So next is internal users. Internal users are those users which are directly involved in the business. So the owner itself, businessman, and the management is the internal user who are directly involved in the business. So all these activities comes under the business when a businessman wants to do a business. The recording of all these entries or all these transactions are not possible in oral way. So we use it as a written way, and the written way is accountancy. So accountancy has different rules and regulations. The concepts on which accountancy is based are different. From time to time, I will tell you the rules and regulation and the concepts of business. This is the definition given by American Institute of Certified Public Accountants, and it is said accounting is the art of recording, classifying and summarizing in a significant manner and in terms of money, transactions and events which are in part at least of a financial character and interpreting the results thereof. This means that accounting is the art. It is an art as well as it is science. So, accounting is the art of recording. To record all these transactions or events is the part of accounting, and classifying. Then we classify all these transactions in different heads. In detail, we will do it. And summarizing. Summarizing means to get the results in a significant manner and in terms of money. That means all the transactions which are related to money is recorded, and all the transactions which are related to money are recorded. Transactions and events, all these called are transactions which are in part at least of a financial character and interpreting the results thereof. That means to show the results. Interpreting means to show or to give the results to the external users, tax authorities and internal users.
What is accounting? Account means explain. Accounting is thus the process of providing explanations. In order to provide explanations, the accounting process records actions or events. These are called as transactions. Thus, accounting is the process of providing information about the transactions of a business. It is for this reason that accounting is called the language of business. It is the means of communicating information to various stakeholders of a business. What is a business? A business is a set of activities for making profit. Profit is expressed as a number, and this number is communicated to various stakeholders through accounting. Let's take a look at Joe's furniture factory. Joe buys logs of wood and processes them at his factory. He makes furniture and sells it to his customers. Joe buys logs of wood at $40 a piece. He spends about $10 in conversion and sells the furniture at $75, thereby making a profit of $25. This is Joe's furniture factory. Apart from Joe, the management and his employees are interested in knowing how much profit he has made. These people are collectively known as internal stakeholders. Joe also has bankers and other investors who have invested money in his business. They are collectively known as external stakeholders. Apart from Joe and his investors, Uncle Sam is keen on knowing how Joe has been performing. Thus, the government is the third stakeholder in any business. The internal stakeholders are providing information about the business in a language called as managerial accounting. The external stakeholders are providing information in a language called as financial accounting. Uncle Sam, the government, have provided information in a language called as tax accounting. Internal users are interested in knowing how the business is doing. For this, they need accurate information. and this accurate information is needed for prompt decision making. Uncle Sam and the government is interested in knowing how much taxes are due. Businesses thus want to show a poor picture to Uncle Sam so that they could probably pay lower taxes. And hence businesses show lower profits to Uncle Sam. External users are interested in knowing how much profits the business is making. So businesses tend to show a good picture to them by showing higher profits. Since businesses cannot use their own method of accounting, these businesses are required to talk a language using some standards called as GAAP. GAAP stands for Generally Accepted Accounting Principles. Similarly, to curb the practice of showing lower profits, there are standards or rules governing the tax accounting. These are called tax laws. An example of the tax law is the Internal Revenue Code. Summary: accounting is the process of providing explanations. These explanations are given by recurring transactions. It is thus called the language of business. In any business, there are three stakeholders. For each stakeholder, the type of information required is different, and hence the accounting is different.